Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, October 8th. In a move that caught everyone's attention but wasn't necessarily a surprise, major central banks agreed to cut their key lending rates in a coordinated fashion. The statement released by the Federal Reserve indicated the Federal Reserve, the Bank of Canada, the Bank of England, the European Central Bank, the Swedish Central Bank, and the Swiss National Bank all joined in on the action, while the Bank of Japan voiced strong support of the policy actions. Presumably, the Bank of Japan's inaction was owed to the understanding that its key rate already stood at a lowly 0.5%. The willingness to cut rates in a coordinated fashion was attributed to a sense that inflation pressures had started to moderate in a number of countries and the intensification of the financial crisis that had augmented the downside risks to growth. The latter, it was determined, diminished the upside risks to price stability. On Tuesday, Fed Chairman Bernanke essentially laid the groundwork for a rate cut when he provided a stark assessment of the economic outlook at the National Association for Business Economics annual meeting. That consideration, along with the understanding that the Fed funds futures market had fully priced in a 50 basis point cut already, are just a few reasons why the coordinated action was not a surprise. The spike in overnight lending rates, the mounting losses in global stock markets, reports of rising credit losses at Bank of America, and word the British government was going to provide direct capital support for 8 major banks were other qualifying reasons in the market's mind. The Federal Reserve, for its part, elected to lower the Fed funds rate and the discount rate 50 basis points to 1.5% and 1.75% respectively. Sticking to the script, the rationale for the move was pinned on evidence pointing to a weakening of economic activity and a reduction in inflationary pressures. The Fed also conceded that there was a feeling that the intensification of the financial market turmoil is likely to exert additional restraint on spending. Now, the stock market's reaction to the coordinated rate cut has been nothing short of frenetic. There was initial excitement that was soon followed by indignation that this action was either too little or too late, or too little and too late. Additionally, there was the onerous thought that it still is not the magic bullet that provides a quick fix for the credit market. The size of the rate cut will matter more to some people than others. A rate cut at this juncture, though, no matter the size, is still better than no rate cut. It is true that this singular, coordinated action isn't a panacea for the credit market's maladies. Nonetheless, it is another supportive measure that works toward unclogging the credit market and raises the long-term appeal of equities at these depressed levels. That last point could ultimately get washed away in another fear-based trade. However, it should be held in trust by investors as a fundamentally positive move for the economy and the capital markets. I'm Pat O'Hare for Briefing.com. Thanks for listening.